Welcome to All Things Real Estate. My name is Margaret Capranos, and I'm a realtor here in Marin County with Zephyr Real Estate. Today's program is going to be on the very difficult decision to either stay or move, especially as you're approaching retirement age. The question of whether to stay in your house is a very difficult one because you've lived there for a long time. You have a lot of memories there and no doubt a lot of possessions as well. Just the chore of moving alone is enough to make people want to stay in place. But there's a real reality as well that this house is probably bigger than what you need. It also probably has a lot of expensive maintenance. And the question is, when your income is reduced post-retirement, how can you keep that house up? Where will the money come from? Does it make sense to take income and put it into an asset that might be illiquid? And what happens if you should need that money? So it really poses the question of, is it smart to stay? Perhaps we should think about moving or downsizing. Today, we're going to really be exploring what it would look like. For one particular option that we have here is a reverse purchase mortgage. We will be hearing from an expert on the topic. We'll also be talking about who else should be on your team of experts to help you to make that decision. There's a very interesting rule that I actually would like to read here. It's called the 4% rule, put out by the Society of Actuaries. It states, for a client who is approaching retirement age, the safe withdrawal rate, which usually is about 4%, adjusted up or down for inflation every succeeding year, as long as the client's goal remains the same, i.e. no need to change the initial asset allocation, you should do what you can, and this is advice for financial advisors, to dissuade the client from being too frisky with spending early in retirement. An initial 5% withdrawal rate is risky, and 6% or more is gambling. So the question becomes, with your initial asset allocation, how do you preserve that? And how can you possibly continue to live and maintain a house such as the one you may be in right now without eking out more money from your portfolio that you need to live on for retirement? So at this point now, what we're going to do is we're going to switch gears and meet with Homa, who is a reverse purchase mortgage expert. And welcome. Now, what can you tell us about this crazy name, Heckham? It's a heck of a name.
It is. It is heck of a product also. But thank you for having me here today.
Absolutely.
And as you said, I've been doing this for many years, and I've been in finance position for about 30 years and doing reverse mortgages for about 10 years now. And it has changed a lot. So what Heckham is nothing but home equity conversion mortgage. So you can use this Heckham for refinance, as you mentioned, or you can use this as a Heckham for purchase. Heckham for purchase is an FHA insured product that came in about 2009 just for the purchase idea, and that was part of the Housing and Economic Recovery Act. This product is FHA insured, and it's for people to use this to purchase a property.
Okay, this is a very interesting concept, and you've talked about that this is FHA insured. Yes. Why is that so important?
Well, when they started having reverse mortgages in 1960s, and it was not FHA insured, and that's why there is a lot of misconception about it, because people lost their houses. But since 1988, FHA has insured this product, and no longer people are losing their houses except if they don't follow the rules and regulation. But it is FHA insured product. So there has been a lot of changes, especially in the last few years, to protect the consumer from every possible thing not to lose their house.
That sounds very important. So why don't we talk about now how you would qualify for a Heckham purchase?
Okay. As I mentioned, it's an FHA product, so we have to follow all the rules and regulation of FHA. People have to be, as long as one of the person on the title is over 62 years old, they can qualify for this program. They have to have this as a primary resident, and they qualify with minimum requirements as financial assessment. So it's easier to qualify rather than the traditional mortgage.
I see. So explain to me who might be interested in getting a reverse purchase mortgage. What would be the configuration or the typical demographic of someone who would apply for this?
Sure. You mentioned about retirement time. So when we become older and we become retired, it's harder to maintain our houses. There must be a lot of expenses regarding maintaining the house, and or the house is 2-story and there is the stairs, or the people want to downsize. They don't want to have any more bigger houses. They don't need to have that bigger houses. They need to relocate to their family, closer to their family. So anybody who wants to downsize, they want to change their house, and as long as they're older than 62, they can use this program. They can sell their existing home and purchase a new house with the reverse mortgage.
That sounds like a great idea. Now, timing-wise, how would you go about doing this? Let's say I decide, okay, I've sold my house, now I want a reverse purchase mortgage. Have I just done that correctly, or did I need to do something else?
It depends on what you are looking for and what is more comfortable for you. You can do it both ways. We can do the same transition as you are putting your house in a market. I'm purchasing a new house, so you can do the same transition. We wait for you to sell the house and buy a new house with the down payment from your existing house. To buy a new house, we can do the same transition, or you can sell your house first and then look to buy a new house with the reverse mortgage purchase program.
So you are looking then to have money available for a down payment?
Yes, you have to have a down payment, and it depends on a lot of different things for the down payment. Depends on how old the client is. We go with the younger borrower age and find out how much they qualify for, what type of property they are buying. We can qualify single family home, 1 to 4 units, townhouses, PUDs, and as long as condos are FHA approved, we can go for that. So they have to have some down payment, which I can find out how much each person qualifies for and let them know how much they need to have a down payment. So they sell their existing home and buy a new house without using all their nest egg cash.
I see. Now, it gets a lot more difficult to qualify for a loan, especially with today's new guidelines and regulations, when you don't have an income.
Yes.
So does this address that issue?
We have some financial assessment requirement, but it's not as the traditional mortgage. We have to have some income, and it's all because they want to make sure that they are protected in their house. Because with the reverse mortgage, there is no monthly mortgage payment required. The only thing that they are responsible for is property tax and homeowner insurance. And FHA wants to make sure that the client can afford to pay their property tax and homeowner insurance so they don't lose the house.
That's probably very important then to adult children who may very well be involved in the decision making of whether to stay or whether to move. And in fact, sometimes people are thinking, you know, I can't qualify for anything, I just better stay in place.
Well, we love to talk to the adult children as well. What I do is meet with the client. If they want to have their adult children or financial planner or CPA involved, we talk to them, I talk to them, and show them how much they qualify for, what the procedures are, what the interest rate are, everything about the loan, So they have a great information to see what they should do, what is the best solution for their parents, what is the best solution for the client to stay or to move.
So in the case of an FHA insured program like this, mom and dad pass, or perhaps they go into some type of an assisted living facility. Suddenly the estate is dealing with selling the property.
Yes.
So what happens if there's a significant downturn in the market? What will the estate look to do at that point?
Great point. FHA, all these FHA reverse mortgages are non-recourse loan. So what it means is the heirs or the clients never owe more than their home value. So husband and wife living in the house, one passes, the other one can still stay in the house, both of them passes, then the estate will sell the property, pay off the bank, and keep the rest of the money. If something happens like a few years ago, market goes down, the property value is not there, they do not own more than their home value. So they can do two things. The state can buy the property with a lower price, or they can sign the deed to the bank and say goodbye. They don't have to come up with the negative amount that they owe.
Well, that certainly sounds like a way to make sure that the estate isn't completely drained of any assets whatsoever. And that had, I believe, been some of the complaints that people had initially about the reverse mortgage.
Well, because they start, if the people who are 62, the life of the loan is for them to become 100 years old. So the older they are, the more money they qualify for. And the younger they are, they have a long way to go, because now we live longer. So, and loan balances increases the same way as the equity increases. So it depends on what time they, if they want to sell the house, they can sell the house, move to another place, move to assisted living or anything. So all depends on what time and when and how much. When they sell the price or sell the property, or if they pass, how much their loan balance is, how much their house is worth, how much do they own to the bank. So all of this depends, but the great thing is it's all deferred mortgage. They don't have to come up with any monthly mortgage payment. So for 25 years they can have this loan without having any monthly mortgage payment. They only pay their property tax and homeowner insurance. And then, of course, the loan becomes due when they move or they sell the house or they pass.
Now, let's say I'm 62 years of age. I still have a few more years that I plan to work. What about if I did want to make a mortgage payment? Could I?
Sure. This is a great flexible loan. It's like a regular mortgage. If you like to make payments, sure you can. You can make payments. I have clients that actually are doing this, and they were 62 and they were still making money, so they wanted to pay the mortgage payment. So they are doing that. So it's up to you. It's very flexible. You want to pay your payments, you can. You don't want to make payments, you don't make payments.
Now, I know you're not a CPA, and probably you will defer to a CPA on this, but one of the benefits of owning a home are the tax benefits. Mm-hmm. So if you are not making a mortgage, then how would you respond to that issue of tax benefits around this?
I refer them to their CPAs.
Okay, but that would be a very important question for them to be asking.
Yes, yes. So usually, when we make payments, we can deduct, and if we are not making payments, we won't be able to deduct.
Okay. Now, what about if I want to move out of the area? Am I constrained to where? No.
It's a very flexible loan. There is no prepayment penalty. I always tell my clients, you win the lotto in 6 months, you want to pay it off, you want to pay it down, you can do it anytime you want. You decided to sell in 5 years and move some other places, or buy another property, you can sell this place, buy another property with reverse mortgage again. So there is no restriction. There is nothing to hold you up to it.
So no limitation on how often you could do this?
No.
You would just have to qualify again?
Yes, you have to qualify. It's like a whole new loan. So you have to go through all the application, all the procedures to qualify for another reverse mortgage.
Now, you had mentioned also that there's counseling, financial counseling involved.
Yes.
Tell us about that.
So FHA requires, because these are all FHA loans, FHA requires to be counseled with an FHA counselor after we talk to them. So that's another step. We give them all the detailed information. When I meet with the client, I give them all the detailed information about everything about the reverse mortgage, how much they qualify, what the interest rates are, how much everything is. And the second step, if they decided to go for it, they have to be counseled with an FHA counselor, which I provide list of 30 counselors to them. So they have a choice that they call them, make an appointment with them to either meet with face-to-face or on the phone. And what they would do is they would go over all the detailed information as we did. They go over all the numbers, and they want to make sure that the client is understanding what the reverse mortgage is and how they are getting into it.
Okay. Well, my understanding is that by not paying a mortgage, you now have money for your everyday living expenses. And as it pertains then to that 4% rule, it would enable you, presumably, to keep intact your retirement portfolios and be able to follow that 4% rule.
Yes, for sure. There's a lot of attention from financial advisors now, and what they are saying is use your housing wealth instead of your portfolio to prolong your cash reserve. We are living longer these days, and we need more money at the elder age, and so it's great to be able to save our portfolio as much as we can.
Especially in a lot of in times of market volatility, much
Yes.
like we're having right now.
That's
So if
for
you're
sure.
siphoning off more than that 4% in a volatile market, it actually could really deplete your assets very
That's right.
quickly. And this is an area with a lot of built up equity in their homes.
That's right. So we say use your equity rather than your cash, so you prolong your cash reserve.